Okay, so you want to own a self-storage facility. No kitchen, no dining room, no chef, no waiter, no reservation system, no front desk running 24 hours, no guest complaints about the pillows. Just a steel box, cut into smaller steel boxes, sitting on a slab of concrete next to a highway off-ramp. And here's the number that made Wall Street fall in love with that box. 78%. That's the operating margin. Public Storage, the largest self-storage company on earth, reported on its core portfolio in 2025. Not revenue growth, not occupancy, margin. 78 cents of every dollar that comes in the door goes straight to the bottom line, before debt and taxes. Compare that to almost anything else in real estate. A hotel is thrilled with a 35% margin. A shopping mall fights for 55. An apartment building, well run, might clear 60. Self-storage clears 78, sometimes higher, with a product that has no plumbing, no elevators in most buildings, and, on a good day, one person behind the counter for an entire property. So the dream writes itself. Buy some land, put up a metal building, divide it into a few hundred units, rent out empty space you didn't have to build twice, that nobody has to move into with furniture trucks and moving crews, that generates income the moment someone signs a lease on a smartphone. And Wall Street doesn't just like that margin. It's legally required to keep loving it. Public Storage, Extra Space Storage, CubeSmart. All three are structured as REITs, real estate investment trusts, which means by law they have to pay out at least 90% of taxable income as dividends to shareholders every single year. A business model that already runs at a 78% margin, wrapped inside a legal structure that has to hand almost all of the profit straight back to investors. That's not just a good business. That's a dividend machine with a storage unit attached to it. That's the pitch you'll see in every passive income video on the internet. Here's what they don't show you, the spreadsheet behind the box. Because the empty box is the easy part. What happens after the box fills up, and what happens the day it doesn't, is where this business actually gets decided. Let's start with the size of what we're actually talking about. The U.S. self-storage industry is worth somewhere around $45 to $48 billion a year. There are more than 60,000 facilities spread across the country. Line that up against the household names you know. That's more storage locations in America than every Subway, every Dollar General, and every CVS combined. 2.1 billion square feet of rentable space. That's not a hotel chain. That's not a fast food category. That's an entire shadow layer of American real estate that most people drive past every single day and never think about, until the day they need it. And here's the paradox at the center of the industry. Roughly 70% of that 60,000 facility footprint is still independently owned. A retired contractor, a local family that bought a parcel in the 1990s, a dentist who wanted a side investment, small operators, one or two properties, running the thing themselves. But that 70% is shrinking every year, because sitting on top of that fragmented mom-and-pop foundation is a different animal entirely. 5 publicly traded REITs, Public Storage, Extra Space Storage, CubeSmart, National Storage Affiliates, and a handful of private equity-backed platforms, buying, managing, and branding their way across the same map. And as we're about to see, in this business, you don't actually need to own the box to control it. Look at how the demand side has moved. In 2005, roughly 9% of American households used self-storage. By 2024, that number had climbed to 12.6%, an estimated 16.68 million renting households nationwide. Occupancy across the large institutional operators averages around 92%. Across the industry as a whole, including every small independent lot on the edge of every town, the average is closer to 82%. That 10-point gap is not an accident. It's the first clue that something structural separates the big platforms from everyone else. And capital has noticed. Transaction volume in self-storage exceeded $10 billion in 2024 alone, with cap rates, the yield buyers are willing to accept, ranging from 5.0 to 7.5%, depending on asset quality and market. For comparison, that's tighter, more competitive pricing than most other commercial real estate categories can command right now. Investors are not just buying storage facilities. They're bidding each other up to buy them. So here's the real question this episode is built around. If self-storage is genuinely one of the highest margin, lowest complexity real estate categories that exists, why do so many independent owners quietly sell out to the platforms after 10, 15 years? Why does an industry with this kind of margin keep consolidating upward instead of staying fragmented? The answer isn't in the buildings. It's in the layers stacked on top of them. And we're about to walk through every one. On paper, this looks like the easiest real estate asset class to build. In practice, the box is where a small operator's plan starts leaking money before a single customer ever shows up. Start with construction. A basic, single-story, drive-up facility, steel frame, concrete slab, roll-up doors, no interior corridors. Runs somewhere between $25 and $65 per square foot, depending on region and materials. That's the cheap version. Now add a second story, or interior hallways, or climate control. Because in 2026, climate-controlled units are what actually rent, especially in the Sun Belt. Multi-story construction runs $90 to $120 per square foot. Climate control alone adds another $20 to $40 per square foot on top of that for HVAC systems, insulation, vapor barriers, and fire suppression size for an enclosed building instead of an open steel shed. And then there's a number almost nobody budgets for at the start: soft costs. Permitting, engineering, architectural fees, entitlement battles with a local zoning board that doesn't want a storage facility next to a subdivision. 15 to 22% on top of the hard construction cost before a single wall goes up. Then, in 2025, a new variable landed on top of all of it: a 25% tariff on imported steel. For an industry built almost entirely out of steel buildings, that tariff didn't just raise costs. It turned marginal deals unfinanceable overnight. So let's stack this the way a lender actually sees it. A basic single-story steel shed, cheapest entry point, lowest rent per square foot, easiest to permit. One story up or climate-controlled. The construction cost roughly doubles, but so does what you can charge. Climate-controlled space commands a street rate premium of 30 to 55% over standard drive-up units. And a full multi-story, climate-controlled facility in a dense metro, the most expensive box to build, and the only kind institutional capital wants to touch anymore, because it's the only kind that actually clears underwriting in 2026. Stack the occupancy thresholds the way a lender actually underwrites them, and the range keeps climbing. A distressed facility, one that's actually losing money against its debt service, might be running below 70% full. A facility covering its bills, but not much else, needs to clear somewhere around 83%. A facility a bank considers genuinely healthy, worth refinancing on good terms, needs 90% or higher, sustained, not just for one good summer. 3 thresholds, each one meaningfully harder to hold than the last, and a first-time owner usually only learns which bracket they're in after the lease-up window has already closed. Here's the twist most first-time developers don't see coming. Even after the building is finished, the money doesn't start flowing on day one. A newly built facility typically takes 18 to 24 months to reach stabilized occupancy, the point where the building is actually full enough to run efficiently. During that lease-up window, operating expenses can eat 40 to 60% of whatever revenue trickles in, because you're paying full-time staff, insurance, taxes, and marketing against a building that's sitting mostly empty. And stabilized itself turns out to be a moving target. Appraisers use one definition: physical occupancy around 85 to 90%. The REITs use a different one, based on a fixed calendar date, not an occupancy trigger. And neither of those is the same as economic stabilization, because a building can hit 90% full while half of those units are still sitting on introductory discount pricing that hasn't matured into full market rent yet. A pro forma that assumes full rent the moment the building looks full has quietly borrowed a year of revenue it hasn't actually earned. There is a way to fight back against those numbers, and developers who survive 2026 are the ones using it. Design-build-delivery instead of the traditional design-bid-build sequence can shave 8 to 12% off hard construction cost and get a facility renting 6 to 10 months earlier, which matters enormously when interest on the construction loan is accruing every single day the building sits unfinished and unrented. But that discipline is a professional operator advantage. A first-time owner building one facility, learning the process as they go, rarely has the relationships or the leverage to access it. Land is its own separate fight, and it rarely shows up in the glossy pro forma a broker hands a first-time buyer. Self-storage needs commercial or industrial zoning, and most municipalities don't want a storage facility as a neighbor to housing. So entitlement can turn into a multi-year argument with a planning board before a shovel ever touches dirt. Every month spent fighting that argument is a month of interest accruing on a construction loan with nothing built yet to offset it. And once the building goes up, the industry itself is racing to keep up with it. Developers delivered 55.1 million square feet of new self-storage space in 2025 alone, enough new space to blanket all of Central Park. That's not one operator's decision. That's thousands of operators making the same bet, in the same submarkets, in the same years, which means a facility that looked like the only option in its zip code when it was designed can open into a market with 2 or 3 new competitors within a mile, all fighting over the same lease-up customers with the same discounted teaser rates. In other words, the box is cheap to imagine, moderate to build, and expensive to fill. And filling it isn't actually where the real money gets made. That happens after. This is where self-storage stops looking like real estate and starts looking like something closer to airline pricing. Every self-storage operator quotes you 3 completely different numbers, and almost nobody outside the industry realizes they're not the same thing. There's the advertised rate, the number you see online, the teaser that gets you to click. There's the move-in rate, what a brand new tenant actually signs for. And there's the in-place rate, what long-term tenants are quietly paying months or years into their lease, after a series of increases they may not have noticed. Let's put real numbers next to that. At the end of 2025, Public Storage reported an average contract rent for tenants moving in of $11.60 per square foot. For tenants moving out, the ones finally leaving after years, $20.12 per square foot. That's a 42% gap between what a brand new customer pays and what a seasoned customer was paying when they finally left. The company's in-place rent across its entire occupied portfolio, $22.55 per square foot. Back in 2020, that in-place rate sat roughly 27 to 32% above the move-in rate. By the end of 2025, that premium had widened to 73% above what departing tenants paid and 94% above what new tenants are paying to walk in the door today. Here's the mechanism that builds that gap, and the industry has an internal name for it. The ECRI, the existing customer rate increase. The operator acquires you cheap. $1 for the first month. A discount code that shaves 17% or more off the advertised rate just to get the lease signed. And then, once you've moved your furniture, your files, your childhood photos into that unit, once the cost of packing it all back into a truck and driving somewhere else is higher than the cost of just paying more, the rate increases begin. Quietly. Repeatedly. Because moving out of a self-storage unit is one of the most annoying errands most people will ever avoid doing. This is not a bug in the model. It is the model. And it's not the only quiet revenue engine running underneath the rent roll. Walk through what a tenant actually signs up for at move-in, and there's a second product sitting right next to the lease. Tenant insurance, sometimes structured as mandatory, sometimes just heavily pushed at the counter and online. Extra space storage and public storage have each generated tens of millions of dollars a year from tenant insurance programs alone, with move-in participation rates above 90% and overall participation running 65 to 75% of all tenants. The marginal cost of adding a customer to that insurance pool is close to nothing. The revenue is close to pure profit. And then there's a third layer that most tenants never even know exists. Some of the largest operators run their own captive reinsurance arms, meaning the parent company effectively insures its own tenants against loss, collecting the premium and absorbing very little of the actual risk, because storage unit claims are rare and typically small. So by the time you add it up, a modern self-storage operator isn't running one business. It's running 3, layered on top of each other, inside the same steel building. The real estate itself, a dynamic pricing engine that behaves less like a landlord and more like an airline seat map, and an insurance operation bolted onto the lease. Look at the 2 REITs that disclose this most clearly. Public Storage has reported roughly $84 million a year in tenant insurance revenue. Extra Space Storage has reported roughly $72 million a year from the same product line. Different companies, different portfolios, but the same underlying trick. Bundle a low-cost insurance product into a lease that a tenant barely reads, at participation rates most retailers would consider a miracle, and let it run quietly beside the rent for as long as the unit stays occupied. And there's a fourth layer stacked on top of the first three, smaller than the rate engine or the insurance program, but still pure margin, the retail counter. Boxes, tape, mattress covers, disc locks. The facility requires you to buy on-site, because your own lock supposedly doesn't meet their security standard. Truck rentals booked through the front office. None of it moves the needle the way the ECRI does. All of it adds up, unit by unit, counter by counter, across thousands of locations a year. None of this required a bigger building. None of it required lower construction costs or better land. It required a rate engine, an insurance product, and a management platform. Three things that live on a server, not on a concrete slab. The building was never the product. The building was just the shelf the real business sits on. And as we're about to see, a gap this wide, between the rate you're promised and the rate you actually pay, doesn't stay quiet forever. Every business built on a gap between what you promise and what you deliver eventually meets the people on the other side of that gap. Start with the investors. Between 2001 and 2010, a San Diego company called Equity-Based Services, operating under the name American Mini Storage, ran syndicated investments across 77 self-storage projects in a dozen states. The pitch was simple. Put your money into one of our storage syndicates, and we'll pay you an 8% preferred return, quarter after quarter, like clockwork. For years, it worked. Investors got their checks. New investors, seeing those consistent returns, put in more money. Word spread. What those investors didn't know, the checks weren't always coming from the property they'd actually invested in. According to the plea agreements later filed in federal court, the company's owner, Howard Kaplan, was diverting funds from better-performing properties to cover the preferred returns on properties that weren't generating anywhere near enough operating profit to justify them. Some of those individual syndications weren't even covering their own operating costs and debt service, let alone paying investors a return. Kaplan and his two sons ultimately pled guilty to conspiring to commit wire fraud, admitting they had stolen more than $500,000 from investors through commingled funds and misrepresented returns. Not a market crash, not bad luck. A structure where the returns paid to early investors were quietly funded by the capital of later investors, running underneath a legitimate-looking real estate portfolio the entire time. Now walk to the other side of the counter, the tenants. In February 2026, the city of New York filed a lawsuit against Extra Space Storage, the second-largest self-storage operator in the country, accusing the company of running what the complaint calls a classic bait-and-switch scheme. The allegations: advertising low introductory rates to get customers in the door, then raising rents sharply, in some documented cases, doubling the price within a single year, with little or no advance notice. One tenant named in the complaint moved in at $236 a month. By the time the city filed suit, he was paying $440 a month and said he'd never been notified ahead of any of the increases. The lawsuit also alleges vermin infestations, water damage, and mold in units the company had advertised as clean and secure, and that the company threatened to change locks and auction off tenants' belongings to pressure payment of disputed fees. New York City's mayor put it in 5 words on social media: the self-storage Wild West ends now. And this wasn't an isolated shot. Industry publications had been warning about exactly this outcome for years, tracking media criticism of the same low teaser, high ECRI pricing model that makes the rate engine so profitable in the first place, cautioning, long before any lawsuit was filed, that if customer complaints kept getting louder, regulators would eventually start listening. In 2026, they did. 2 very different failure points. One is what happens when a private syndicator lies to the people funding the box. The other is what happens when a public company optimizes the pricing engine so aggressively that regulators start treating an industry practice as a legal violation. But notice what both failures have in common. Neither one happened because the underlying real estate stopped working. The buildings were fine. The land was fine. What broke, in both cases, was the promise sitting on top of the real estate, The promise of a steady return, the promise of a fair rate. The box never lies. The pricing on top of it can. So if the building itself isn't where this business gets decided, who actually comes out ahead? Look at what the largest operators have been building for the last 2 decades, and it isn't more owned buildings. It's a platform that doesn't require ownership at all. Extra Space Storage's third-party management program, called Management Plus, now runs the operations for roughly 40% of the more than 4,000 stores carrying its brand, properties the REIT doesn't own, but manages for outside owners in exchange for a fee. In 2024 alone, third-party management and tenant insurance together generated $182 million for the company. Since the program launched in 2008, Extra Space has spent roughly $2 billion acquiring facilities that started out simply as management clients, properties it got to know intimately, at close range, for years, before ever writing a purchase offer. Public Storage runs the same playbook. And in July of 2026, the company closed a $10.5 billion acquisition of National Storage Affiliates Trust, folding an entire competing platform, brand and all, into the largest operator in the industry. Rewind a few years, and you can watch the funnel being built in real time. Back in 2021, Extra Space was managing 768 third-party facilities. CubeSmart, 718. Life Storage, 340. Public Storage, the biggest owner in the industry, had only 131 because for years it didn't need the funnel, it simply bought. Every one of those management contracts is a live look inside a competitor's books, its occupancy, its rate structure, its weak months. And every one of those relationships is a door that opens, eventually, onto an acquisition offer. That's the mechanism behind the number from Step 2. Roughly 70% of U.S. facilities are still independently owned, and that share keeps shrinking. Not because independent owners are bad operators. Because the platforms sitting above them can offer something a single property owner can't match alone. Brand recognition that lowers customer acquisition cost, revenue management software that runs the ECRI more aggressively than a local manager ever would, and a bridge loan desk that can hand a struggling owner exactly enough capital to survive one more year, on terms that favor the lender. Here's the pattern, stated plainly. While an independent owner is out raising construction loans, fighting a zoning board, and carrying 18 months of negative cash flow during lease-up, the REIT is quietly signing management contracts on that same owner's competitors down the street, collecting a fee either way, gathering pricing data across the entire local market, and building a short list of acquisition targets out of the very owners it's supposedly just helping. Not because the REIT builds better buildings. Not because the REIT charges lower fees. Because the REIT controls the brand, the booking technology, the revenue management software that sets the ECRI increases, and the insurance product, the 4 layers that actually generate the 78% margin, independent of who happens to hold title to the concrete. The independent owner who built the box carries the construction risk, the vacancy risk, the lawsuit risk if pricing goes too far, and the debt on the balance sheet. The platform on top carries almost none of that, and still gets paid every month the box operates, whether it owns that box or not. While the independent owner spends year 1 fighting a zoning board and year 2 absorbing negative cash flow during lease-up, the platform down the street is doing something completely different with that same year. Signing a management contract on the property next door, harvesting its rate data, and quietly deciding whether it's worth an acquisition offer in 18 months. 2 operators, same market, same calendar. One is building an asset, the other is building a map of every asset worth eventually owning. That's the same asset-light instinct you'll find running through hotel franchising, fast food franchising, or any brand plus fee model layered over someone else's capital. Self-storage simply hit it better because a storage unit doesn't look like a franchise. It looks like a landlord renting you a box. It rarely is anymore. No kitchen, no chef, no front desk running around the clock, no plumbing to fix at 2 a.m., no staff to schedule for a holiday weekend. That was the pitch at the start of this video, the simplest, cleanest real estate asset there is. And on the surface, that's still true. The box really is cheap to imagine and simple to operate. But underneath it sits a pricing engine that quietly widens the gap between what a new tenant pays and what a loyal one pays, year after year, until moving out costs more in effort than staying costs in money. And underneath that sits a management layer that doesn't need to own a single door to collect a fee on every one of them. One that would rather manage 1,000 boxes it doesn't own than build 100 it does. So here's where this one has to end, the same way it always ends on this channel, with a question, not a verdict. If you signed a storage lease at a rate that felt like a bargain, and it's crept up every year since without you noticing exactly when or by how much, are you paying for space, or are you paying for the effort it would take you to leave? And if you're the one thinking about building the box, are you actually building a business, or just building the asset that someone else's platform is waiting to manage for a fee and eventually buy?